What's up, everybody? My name is Demetri Kofinas, and you're listening to Hidden Forces, a podcast that inspires investors, entrepreneurs, and everyday citizens to challenge consensus narratives and learn how to think critically about the systems of power shaping our world. My guest in this episode of Hidden Forces is Adam Butler, the CIO of Resolve Asset Management, an alternative asset management firm that focuses on providing cutting-edge, globally diversified, and systematic investment strategies that are non-correlated to traditional portfolios. In the first hour, Adam and I evaluate and explore the structural changes that our economy has undergone since the 2008 financial crisis, along with their consequences for market accountability, monetary policy, and the stability of our political economy, all in the context of discussing his approach to financial modeling and systematic investing. In the second hour, we engage in an expansive and valuable discussion about the mind-bending progress being made in artificial intelligence, how it's already disrupting multi-trillion-dollar industries, the incredible promise that this technology holds, and the dangers that it poses to the stability of our economies and political systems. If you want access to that part of the conversation, and you're not already subscribed to Hidden Forces, you can join our premium feed and listen to the second hour of today's episode by going to hiddenforces.io/subscribe. All of our content tiers give you access to our premium feed, which you can listen to on your mobile device using your favorite podcast app, just like you're listening to this episode right now. If you want to join in on the conversation and become a member of the Hidden Forces Genius community, which includes Q&A calls with guests, access to special research and analysis, in-person events, and dinners, you can also do that on our subscriber page. And if you still have questions, feel free to send an email to info@hiddenforces.io, and I or someone from our team will get right back to you. Lastly, because this conversation deals with investing, nothing we say on this podcast can or should be viewed as financial advice. All opinions expressed by me and my guest are solely our own opinions and should not be relied upon as the basis for financial decisions. And with that, please enjoy this incredibly expansive and invaluable conversation with my guest, Adam Butler. Adam Butler, welcome to Hidden Forces.
It is so great and exciting to be here. We've had the chance to have a conversation in person, and we've hosted you on our podcast, Resolve Riffs, and it's always been just really interesting and fulfilling. So excited to have this chat.
Yes, you were at our Austin dinner along with many other very smart and interesting people. Yep. And I should mention this because I've never actually done this. I don't think I've ever once, since we launched the Genius community in the 2 years that we've had it, ever cited a name of the people at the dinners, but I feel comfortable at this point doing that. I mean, just as an example for people to understand, our next dinner, which is in New York this week, the folks that will be there will be Philip Carlson-Slezak, Josh Wolf, Henry Olson, the political analyst, James Aitken, who was recently on the podcast, and a number of our really excellent members. And that's really how these dinners are. They're a mix of members and special invites, and you were one of the special invites to our Austin dinner, and I love it, man. I love it. I try to always bring new people, new faces. The conversations are great. They're always thematic. I don't remember what the theme to that dinner was, but the theme in New York is understandably about the upcoming elections and their impact on the economy and national security. So,
yeah, Lacey Hunt led the conversation at ours. And I mean, he just comes at the issues of fiscal profligacy and Fed response functions and R-star and all kinds of stuff in a very unique frame. So he's always fabulous. It has sparked a tremendous conversation. And there were awesome contributions from the guests as well.
Yeah, Kevin Coldiron was also there, who has been on the podcast, who wrote The Rise of Carry. Marshall Kozlov, who hosts the Realignment podcast and is a really smart, I was about to say kid. I shouldn't call him kid because it almost sounds derogatory, but I mean it in the most endearing sense because he's a young, smart person. And so anyway, they're great. It was a lot of fun. I had fun catching up with you in person, but we'd already been in touch for years. I had been on your podcast some years ago, and I deeply respect I've used this term, Renaissance mind. And I'm very excited to have you on, Adam, because every now and then I bring people on the show who I feel like I can have a kind of almost off-the-record conversation with that's more casual, but nonetheless fruitful. And while I've structured an outline for our conversation, and some of the things that I hope to speak about are AI, which you do a lot of work in, we'll get into that, and the economy, et cetera, I'm sure we'll go all over the place. We'll riff. So just to start off, you're the CIO of Resolve Asset Management. What is Resolve?
Resolve was founded in 2015. I've got two business partners, Mike and Rodrigo, and it grew out of a recognition after 2008 that the way that we've been thinking about the investment paradigm, which had largely been trying to sort of navigate the macro view using narratives and an understanding of the global economy and the different degrees of freedom and moving parts, and just getting the really big calls so spectacularly wrong in 2008, and then a period of very unpleasant reflection around why was I so miscalibrated, or why were we so miscalibrated in that. And it wasn't that we were miscalibrated about what was about to happen, what were the causes of the collapse, what were the local nexi of that collapse. In other words, where was that risk most likely to manifest and when? We actually got those calls right, but what we failed to do is recognize the capability of governments to step in and change the rules. So, we ended up doing very, very well until government stepped in and changed the mark-to-market accounting rules and accelerated the quantitative easing. And, we've been short all of those sectors and having a fantastic year. To be fair, I had some big commodity bets on. So, it's not like we had a huge double-digit year accruing, because the commodity bets offset a lot of our bets against the banks, et cetera. But, the unbelievable reversal that happened when they reversed the market accounting rules and introduced TARP and quantitative QE1, QE2, QE3 were extremely disorienting and disheartening. And that set us on a journey. And one of the individuals that was really a huge catalyst for my shift in thinking was Philip Tetlock, who I'm sure you're familiar with and is a great inspiration to me. But I happened to stumble on a lecture that he gave to the Long Now Foundation, I think back in 2009, on his book, Expert Political Judgment, where he described, first of all, the motivations for his experiment, and then the data that he collected and what they discovered from parsing that data. So are you familiar with that book and that experiment?
I'm familiar with super forecasting, but I may have been told about the experiment in other podcast interviews. But why don't you go ahead and tell me, because it'll be useful and, of course, helpful for the audience.
So Dr. Tetlock graduated, I think, with a master's or a PhD in psychology. He went to work in the intelligence community in DC. And as a starting analyst, he was charged with effectively being the secretary at meetings. So he would be taking notes on what these senior policy analysts, senior military analysts, senior politicians, et cetera, had to say about what they were observing in the Kremlin and the Politburo, and economic situations, et cetera. And then he would be responsible for reading out the minutes, a summary of the minutes at the next meetings. And what he observed was that there was virtually no correlation between what these senior analysts had forecast was going to happen and why, and what actually happened over the subsequent months and quarters. And so he took this and went back to university and got sponsored to do this large study. So he recruited about 180 experts, on average about 16 years of experience across a wide variety of fields: economists, senior journalists, senior policy analysts, people working in the intelligence community, et cetera, and average level of educational attainment of master's level. So experts in their fields. And he asked them about 100 questions each over the course of about 10 or 12 years. So he accumulated about 18,000 answers. And he asked questions in a very specific way. So what do you expect to happen? And what is the probability that you assign to this expectation, right? So he was trying to measure not just the accuracy of people's forecasts, but also the calibration of people's level of confidence to their accuracy, right? So he's got 18,000 observations over this long period across a very wide variety of complex domains. Questions like, will the inflation rate in France rise above 3% or not? Russia, will the USSR expand, their border in this direction or what have you? So very specific questions with very specific anyway, so all this data, he summarized the results. So some interesting counterintuitive things came out of this. Number one, people are not very good forecasters in their own domain of expertise. In fact, when he asked questions to experts outside of their domain of expertise, they tended to actually be both more accurate and more well calibrated than within their domain of expertise. The experts most likely to be cited in academic journals or appear on TV or in newspapers, less accurate and less well calibrated than those who toil in greater obscurity. There was not a single expert who demonstrated either an accuracy or a calibration above 50%. So, in aggregate, we're not very good. But when you take the average of everybody's response, that was better than any single expert, right? And alongside this, he also ran some simple algorithms, right? So over the short term, things typically will revert to the mean. Over the long term, things will typically follow the same trend that we've observed over the last many years or decades, right? And these simple algorithmic approaches outperformed all of the individual experts, the aggregation of all experts, like the average of their views, and had an accuracy level that was greater than 50%. And by virtue of their design, were as well calibrated as you could be because they were able to determine.
When you say outperformed all of the experts, I'm assuming you mean all of the experts across a wide range of questions that they're asked, right?
Correct. Yeah. So the capability of the algorithmic approaches was they ran these algorithms against the humans on each of the questions and then evaluated them both against the individuals and against the average views of all of the individuals. And the algorithmic approaches came out on top in all of these different metrics, right? So this was a really big wake-up call to me, who had been using more of a discretionary or clinical approach to forecasting and problem solving in markets, and led me down this path to systematic models and ensembles and machine learning, and just as a way to measure the calibration of models on how they perform out of sample, that sort of thing. And so Resolve really grew out of this recognition and our application of what started out being fairly simple models and grew into ensembles of simple models and then ensembles of slightly more complex models, and expressed in a global macro context.
In order to be bullish on the use of systematic passive investing strategies, do you need to necessarily trust that there will always be some sufficient number of discretionary investors? And is there some way of knowing what that number is?
You need to assume that there is some proportion of less well-informed investors. I mean, there are bad models just as there are bad human forecasters, right? So, as I scan the infosphere in my domain, most models are bad models. I mean, the canon of empirical finance is littered with a statistical technique that doesn't actually give you any information about what to expect in the period after the experiment was conducted. Everything is in sample, right? And so to me, the biggest benefit of machine learning, and we could talk about how machine learning sort of blends into AI maybe at some point, but the benefit of machine learning is that it breaks a problem up into the data that you learn on, so the data that you calibrate your model on, and then the data that you hold out from that calibration process. And once you feel comfortable that you've calibrated the model to the best of your ability, you then apply it to this out of sample data set to see what the true error rate is, to estimate what that error will be when you go to deploy this live, right? Whereas all of the empirical literature that originates largely out of the Chicago School way of thinking, is all in sample, and there's no, or not all is a big statement, but the majority of the canonical literature is based on in-sample testing exclusively. And so it doesn't really give you any information on what to expect out of sample or how to use the in-sample information to make better decisions on what models to deploy and with what confidence. And that's what I spend the last 15 to 20 years on of my life. I could talk about that ad nauseum in whatever depth you might want. But the reality is that the world of finance is much more random, and it is much harder to select good strategies that will have expectancy to outperform out of sample than most people realize. And that's why we tend to really prioritize diversification in every dimension that you could possibly prioritize it.
I don't know if you heard my conversation with Doan Farmer on complexity economics.
I did, yes.
Agent-based simulations, but there's some crossover there with what we talked about in that episode and what
Agreed.
you're talking about. So I definitely recommend people listen to that. So, okay, then take me back now to the 2008 period. And as you said, you were well positioned for the crisis, but you were caught flat-footed or blindsided by the effect that policymakers had in changing the rules of the game. What was it specifically that you were unprepared for, beyond the fact that you were unprepared for the changes? Was it that your theories of money and credit didn't reflect the new realities of how monetary policy and the monetary system worked? Or was it something more fundamental along the lines that we were just discussing, that your approach at modeling using statistical regressions and sampling from historical data was wrong?
I think it was a little bit of everything. I think that my economic framework was overly simple, that I had gotten a major theme correct, and that had built some overconfidence. Like the emerging market commodity cycle theme, I had gotten very right for several years. And I started to maybe see too many things through that prism. And so there was a little bit of a miscalibration there. It was a failure of imagination around what the different tools the authorities could bring to bear if pressed to change the rules or change the trajectory or fundamentally just change the game. So I think it was a variety of different things. Eventually, it was just a recognition that, and I still hold this view generally to this day, that the economy is a complex adaptive system. It is emergent in every conceivable sense of the word, and that it is not very fruitful to try and understand it or at least make decisions in markets on the basis of some clinical or narrative-based understanding of the underlying dynamics. It's just, there are too many degrees of freedom, there are too many interactions, and those interactions are too complex and reflexive for any individual human, and I would argue any individual algorithm, to be able to navigate. And our strategies use tens of thousands of different algorithms, all viewing markets from a slightly different angle. Like, you've seen this image of the black hole. So that image is a computer synthesis that's an aggregation from a wide variety of different spectra and different ways of observing that black hole. Well, it's the same sort of thing, right? We're viewing markets through a wide variety of different spectra and then aggregating those signals to get a more fulsome view. And I mean, if you look at the Kaggle competitions, which are just these machine learning forecasting competitions, all of the top scoring teams now are using, ensembles or meta ensembles of some kind. And it's just because you're trying to model highly complex systems. And so there's no single right way. And there's so much conditionality in the process of forecasting that some of your models are going to be well fit to certain conditions and others for different conditions. But on average, you're likely to converge on something that's better than. So it's this idea of the gestalt, right? Where the whole ends up being better than the sum of the parts.
Yeah, no, totally. I get that. I mean, The application of these models to finance is yet another area where we can expect to see some potentially enormous benefits accrue as a result of the advancements happening in AI and machine learning that we're definitely going to talk about in the second hour. Did you ever hear my conversation with Gary Gerstle on the rise and fall of the neoliberal order? He's written a number of interesting books, two of which were relevant to the conversation. One was about the New Deal order, and one was about the neoliberal order. And the conversation was about the breakdown of the neoliberal order and the move to something new. And so I think about that in the context of your befuddlement, mine as well, at the changing of the rules that occurred. Our naivete at politicians' willingness to change rules that we thought were so bedrock and fundamental in domestic policy that impacted the economy in 2008. And I think we are now seeing something similar in the international arena. And speaking for me personally, I grew up, Gulf War I, which I identify as the commencement point for the New World Order and the internationalization of neoliberalism. This was, of course, right after the fall of the Berlin Wall and the collapse of Soviet communism. I was 10 years old then. So I grew up in this world, and I took many things for granted. And so my sensibilities were assaulted in 2008. And I think that in many ways, like, we're living in the revenge of today in the world of the revenge of politics, the revenge of geopolitics, of national security, of more bedrock concerns upon which economies are built. That's the other thing that's also interesting when you compare classical liberalism or libertarian thought or anarcho-capitalism with, I think, more accurate views of how the economy works. Libertarians will often assume that economic relationships are more fundamental, when in fact politics and power is more fundamental, and governments create rules of the road that set the conditions for which an economy can or cannot flourish. Do you know what I mean? What are your thoughts on that? Like, how does that relate to your experience and your insights?
I think I went from a view that economies and markets were much more organic and unmanaged prior to 2008. And I think upon reflection that I was too naive about that going into 2008. And then, of course, in 2008, we really were able to see just how managed and the types of tools that governments are able to bring to bear on markets and on economies. And over the last 15 years or so, we've seen more tools emerge, right? We've got these swap lines were put in place late in 2008, right? So you've got this euro-dollar market that exists outside of the US. So basically any dollar that's originated at a bank outside of the US banking system is a euro-dollar credit. So a bank in France makes a dollar loan to a French citizen. Well, prior to 2008, those dollar loans were not collateralized with dollar holdings, right? They're not collateralized with dollar holdings now either, but the banks were net short dollars against their euro collateral, right? Prior to 2008. And in 2008, there was this huge dollar collateral call for which the global banks they did not have the collateral, which means they had to use their euros to go and buy dollars from the dollar system. And there was just a shortage of dollars, right? So the dollar rose tremendously. There was a shortage of high quality collateral like T-bills and treasury bonds. And there was a run on that. And so the Fed implemented these swap lines, which provided lines of credit to foreign banks. So they were able to provide them with effectively unlimited amounts of dollars as loans to fulfill their dollar liabilities. So I wasn't familiar with the Eurodollar system prior to 2008. That wasn't really on my radar. But these swap lines, along with QE and all of the other tools that have been brought to bear, including now buying credit outright and buying ETFs of credit outright in the wake of the pandemic crash, they've just demonstrated the ability to move further and further into the realm of direct manipulation of public markets and prices. And I think we should all just acknowledge now that we operate within a fully managed financial system where the authorities have all of the tools necessary at their disposal to ensure that we never have a 2008 style crisis again, and even a recession, or certainly recessionary conditions reflected in financial markets again. And so the big risks now don't really exist in the areas of the market that most people typically look, but rather they're externalized to the political domain and to the social domain. So for example, the big risk that I see is at some point in the future, there will be a political party that will be put in place in Europe or in the US or like a major economy where the party will recognize the people's frustration and anger about various issues, one of them being that more and more people are feeling left out or feeling left behind, and perceiving that the Fed is a major instrument of that, of propagating this accelerating gap, and will just decide to take away power from the Fed to use those tools on behalf of markets, right? And so this is now the type of thing that market participants need to price in, and they just don't break out in one direction or another. But when we do sort of lose equilibrium, they break out fast and they break out to a much larger extent than they used to. And these real risks that could generally derail the economy and the financial markets are risks like the people wresting control of the monetary system from the Fed, which is not on people's radar.
Man, so much to respond to. I feel like there are two separate threads there. One is your realization about the euro-dollar market. And there, I want to point listeners to, there are many episodes that we've done on the internationalization of the dollar system, the euro-dollar system, but one in particular with Lev Menand about the evolution of the euro-dollar system is one I highly recommend, because the dollar really is, at its core, it's a denomination. It's a denomination. And French banks operating outside of the Federal Reserve System have the ability to issue dollar-based loans without actually secure collateral, and gaining unlimited access to dollar swap lines gave them a lifeline where they didn't have one. And it's so important for understanding the strength of the dollar and why it goes up in these kinds of credit crises. I also recommended a conversation I had with Katarina Pistor about when Adam and I were talking about regulations and laws and how those really create the rules of the road that determine what kind of economy you get. She wrote an excellent book on that. We had a great conversation about it. And also further to your point, just to close off this thread and then go to the more interesting one about political instability, to your point about the authorities' ability to arrest crises, just look at SVB. If SVB had happened in 2008, that would have been a full-blown crisis. But what do? They had a quick resolution for it, and they tightened 3 more times. They raised interest rates 3 more times. So really great points. With respect to political instability, back in 2008 or 2009 or 2010, around that period, I remember tweeting about this, which was that the way I thought of it then was that the suppression of financial volatility through QE and these constant interventions and forward guidance and the coddling of the yield curve was causing a buildup in political instability in the same way that, and this is a metaphor and I hope it doesn't get too twisted, a functioning democracy like that of, say, the Italian Republic, which has seen the fall of countless coalition governments since World War II, when it's functioning well, has a lot of political volatility, but it has regime stability. Whereas, and this, again, would metaphorically apply to how we conduct monetary policy in 2008, a more managed political system like that of Iran has very little political volatility, but enormous, unqualifiably large amounts of regime instability. So I think you make a very great observation, which is that the choices we have made to quell the volatility in financial markets and kick the can down the road are now showing up in our politics. They're showing up in the reshaping of politics and the rise of populism, which is the population's attempt to circumvent the intermediary role of elites in shaping political outcomes. And, lastly, just to emphasize one more thing you said about the dangers this poses to Fed independence. I think this is partly what you see in some of the solutions prescribed by practitioners of MMT, which include the abolition of Fed independence and the incorporation of central bank policymaking into Treasury. Are you concerned about what that would mean in practice to lose Fed independence? Nominal Fed independence, I should say, because at the limit, central banks are not really independent.
I think the context of how that happens is really important. So I think that the modern era of financial markets started either in 1987 or in 1998. In 1987, the Greenspan had only been Fed chair for a few months, and he had to coordinate, or he did end up coordinating this large response to the October 19th crash in 1987. And in doing so, introduced this concept of the Fed put, which was then crystallized in 1998 during the, what was originally called the Thai baht crisis and eventually sort of reappeared as a schism in the Russian sovereign debt markets. And it turned out that this firm, long-term capital management, had been extremely long Russian debt against some other trades because they were a stat arb fund. And in order for stat arb funds and credit to be able to generate the size of returns that the partners expected, they need to take on a huge amount of leverage. So you've got this massive amount of leverage on a bet that has gone horribly wrong. And who provides this leverage? Well, the major investment banks. And so since all these major investment banks are now so interconnected, they were in 1998, they're even more interconnected now, the Greenspan Fed identified that this could be sort of a cascading financial catastrophe. And they stepped in and bailed out long-term capital management, right? There was another manifestation of this Fed put. And then we saw the real Fed put in 2008, which we've already hashed out. And so over this time period, what the Fed has done is they've conditioned investors to believe that they can take as much risk as they want, because when the chips are down, they will step in and do whatever it takes to save the financial system, preserve asset markets, and preserve the status quo. And as a function of that, financial markets, just seeing that there is no real risk in financial markets anymore, have scaled up the amount of leverage and the proportion of assets that are allocated to risky assets versus safer assets, like, for example, treasuries, to the highest ever. So, for example, the proportion of household balance sheets that are allocated to equities today is at the highest level ever, right? So the reason for this is that the Fed has made an implicit promise, and not just the Fed, but global central banks have made an implicit promise to the market that they will always be there to ensure that their wealth grows over time. And we've also changed legislation to accommodate this. So, the legislation that they've introduced over the years, mandating default allocations to equity funds, to passive index funds, again, continue to perpetuate this by providing a constant bid to markets. And we can get into what some of those microstructure effects if you want. So we've linked now the markets to virtually every dimension of our lives, right? Like your healthcare is tied to your employer. Your employer's health is intertwined with the market, and the market now ends up being the tail that wags the economy dog because it's just so much larger than the economy, and because such a large proportion of the credit that is issued against the economy is not issued against future cash flows, but rather against collateral, right? So if you've already got capital, you've got access to cheap credit and basically as much as you want. If you don't have capital, then all the income in the world is not going to give you access to cheap credit, right? So you've got the Fed setting up a situation of intense moral hazard with this implicit promise not just to the priests of finance and their banks and their hedge funds, but to the citizenry at large, and tying it to their employment and to their health benefits, et cetera. So you've now got a Fed and a government that understand how to use the tools to effectively manage the economy and avoid recession and financial bear markets, et cetera. And you've got a citizenry that is conditioned to believe that they can be successful and will be successful with this. And so, we've got this financialized economy, right? And I think this financialized economy over time has severely constrained the degrees of freedom that we have as governments, as central banks, as broader institutions to effectuate policy, because we can't really effectuate policy that might compromise growth, that might cause sustained inflation, et cetera, because the financial system is so over leveraged and so reliant on a nominal growth rate that exceeds the interest on the debt, that only the solution space that overlaps with those primary objectives can even possibly be considered.
So just to summarize, one, would you agree with the framing that the stock market has gone from being a marketplace for allocating capital to more of a savings vehicle for ordinary Americans?
Yes.
Is that one way of summarizing what you said? And is the second way of summarizing it also that the U.S. government has increasingly taken ownership over the performance of that savings vehicle, and so when things don't go well, they get the blame for it?
Oh, yeah, absolutely.
It becomes a political problem. So
Yeah.
Does that explain, for example, in this most recent cycle, why, and this is a question I think I raised to James Aitken, why Jay Powell was late to raise and early to cut, because there is a bias for number go up?
Well, I think Jay is operating in good faith. Look, we just don't have any real precedent for inflation over the last 30 years, right? And every time the Fed has become concerned about inflation over the last 30 years, they have become over-vigilant. And I think many argue that they've actually caused financial crises. So, I think Jay was being prudent in waiting. I think we can look back in retrospect and say, obviously he was slow.
Because there were many
he
reasons
missed the boat,
to believe that inflation was an exogenous event driven by supply chains and other COVID-related matters.
Absolutely. I mean, there was a lot of narratives for why that inflation spiked the way it did. And I don't think that those debates are settled. I think we can maybe say that the inflation has been more transitory than many people feared. Whether we can attribute that to Fed policy or not, I'm not sure. But it definitely was more transitory than...
You never bought into the argument that made by people like Larry Summers that whether or not the inflation was primarily driven by exogenous factors, that it could become embedded through inflation expectations. That was, I think, one of the arguments for preemptive raising. Was that something that you never really bought into?
Oh, yeah, absolutely. I mean, and what does the expectations channel really mean, right? Well, it means that employees, the labor force is going to get uppity about their demands for getting raises, right? Like, let's keep in mind, right? Profit margins for US corporations have been rising for the last 30 years and are currently at the highest they've ever been. Now, part of that is due to a change in the mix of companies in the S&P. We migrated from maybe more of an industrial base. In 2008, keep in mind, it was dominated by sort of commodities, oil companies. And now it's dominated largely by tech. And tech has always enjoyed higher margins than other sectors. So some of it's compositional. But any way you slice it, the private sector is currently operating at the highest margins ever. They have been operating at the highest maybe not the highest margins ever. I know there were periods back in the 40s and 50s when they had very high margins as well. But either way, we're at the very upper end of that channel. So there is room for the corporate sector to allow for some labor inflation. In other words, some increase in wages for labor to be capturing a larger percentage of the economic pie, which has been largely accruing to the corporate sector for the last 30, 40 years. But it is economic dogma that wages are part of our measures of inflation, but the prices of homes are not really, and the prices of assets are definitely not, right? So, our language and our policy and the way we measure things over time has really evolved to be just vastly preferential to capital over labor. And Larry Summers saying, well, the expectations channel is what we're really afraid of. That's largely a concern that labor is going to get uppity and start demanding higher wages. And that sort of fear of a wage spiral, it was a wage spiral along with a commodity scarcity that drove sustained inflation in the 1970s. And I think that there was a fear that we might repeat that cycle, though in reality, most of the elements that contributed to inflation in the 70s really weren't present and weren't primary factors that led to the spike in inflation in the recent episode.
So let's take one of those, which is demographics. Obviously, today's demographics are less inflationary by the traditional way we think about the relationship between demographics and aging demographics and inflation. But when you take a more nuanced view and you consider the growth in public sector debt, the growth in unfunded liabilities, as well as people's expectations about the role of government in the economy, you could make the argument, as one of our previous guests, former chief economist for the Bank of England, Charles Goodhart, has, that aging demographics and a rising dependency ratio will actually be inflationary because the government will need to print more money to finance the deficit along with interest payments on the debt in an environment of sluggish economic growth where the deflationary headwinds of globalization are also in retreat. I'm curious, one, are you familiar with that argument? And two, what do you think of it?
I am. Yeah, I think so. The argument goes that older people, they tend to have a larger proportion of the institutional alpha, right? Just the understanding of the machinery that makes a business run. And so as these older people move out of the workforce and are replaced by younger people who are just beginning to learn the ropes and the institutional machinery that allow whatever organization that they've just entered to mobilize productivity, then we're just going to become less productive, right? And there may actually be a slight shift in headcount. So you may have just during certain periods of different overlaps of when these generational bubbles rise and fall, that there may actually be, a period where the labor force itself may shrink just because more people are retiring than are entering the labor force. And therefore you'll have effectively a labor scarcity, a loss of the most productive element of the labor force at the same time. And this will cause a shift in the supply-demand dynamics for labor and increase the cost of labor and thereby, propagate inflation.
Combined also with fiscal spending in the context of rising debt levels and rising interest costs.
Yes. Yeah, absolutely. I'm not sure that those two things have to be linked, but they certainly are linked at the moment.
So do you have a view on whether we're moving into a period of secular inflation? Because there are, the opposite view of this is someone like Mike Green, who I don't want to misrepresent his views, but until recently, I'm pretty sure at least his view was that the forces of deflation that were present during the long, great moderation period under Greenspan and Bernanke are still with us, and that the inflation that we did see was in fact transitory, and that this is much ado about nothing. Again, I don't want to misrepresent Mike's views, but that's sort of the view that I've come away with. Where are you on that? Are you on the camp of, deflationists, or are you on the camp of someone like Goodhart or maybe like Russell Napier, who view it more as a structural inflationary environment driven in no small part by government fiscal spending?
Yeah, so I know Mike quite well, and we've discussed this at length. I'd say that I started out having a stronger confidence in sustained inflation, and that my views have shifted to feel that we're likely to have more moderate levels of inflation and potentially even disinflation over the next decade. But a lot depends on things that are outside the economy. Like if we get a major escalation in the Russia-Ukraine conflict, if we get a major escalation in the conflict in the Middle East and it drags in the Saudis and the other Arab states, and like you can absolutely see situations where you get some sort of major commodity supply disruptions or other states of affairs that might produce a substantial inflationary impulse. The Trump presidency potential is a huge wild card. He has promised to raise tariffs on a variety of goods from, already relatively high levels up. He's said he's going to raise them 4 times. I think he said from 50% to 200% on this broad basket of goods. These kinds of policies can be very highly inflationary in the short term. So there's just a lot of moving parts. The natural state of the economy, if we can avoid major conflicts, if we can avoid major political and policy moves that run counter to the sort of neoliberal order that we have been following the trajectory of for the past 20 or 30 years, is disinflationary. A major conflagration with China, obviously, could be highly inflationary since we import so many goods. A major conflict involving Taiwan. Now, think about the proportion of the economy that currently depends on AI or computational derivatives. That would obviously be a massive blow to the supply of global chips, global computation. So that has downstream effects. The longshoremen strike. Here's an example of political shock that could have very profound effects if we've solved that problem in the short term, but we've got to go back to the drawing board in mid-January, and this could all fall apart, right? And I wonder how would a Trump administration deal with the longshoremen versus a Kamala administration. So that actually has a very big impact. If we feel that Trump is unlikely to be conciliatory with the longshoremen strike, then we should be ready for a protracted period of a major shutdown of global trade, at least through the world's largest global importer and consumer. And so that could be a pretty substantial inflation shock. So there's a number of dynamics, I think, that could, especially if one or more of them converge and happen at the same time, could really change the rules of the game. But the natural state of the economy is disinflationary, especially in a period where the Fed is managing the economy for relatively low rates, and people are generally inclined to take large risks on uncertain technological bets.
It would be fascinating to see what would happen in a number of venues if Trump were to return into office. The longshoreman strike is just one example, and that actually made me think about Ronald Reagan and the air traffic controller strike. And it's hard to believe that he replaced all those air traffic controllers overnight. He just fired them all. That was, I don't know how many there were, but that was an incredibly gutsy move that could have not worked out in his favor, and it ended up working out. I just thought about how much more difficult is that to do that in this case? How many more longshoremen are there? I don't know. Are there more? I presume there are.
Well, yeah, and Thatcher with the coal miners, for sure.
It would be interesting. So look, Adam, I'm going to move us to the second hour, where we're going to transition our conversation to what I'm most interested in speaking with you about today, which is the remarkable progress that's being made every single day in AI, a field that you know quite a bit about and have devoted quite a bit of time to understanding as part of your work, and also out of personal interest, I'd say. And I want to understand how, one, you're using this technology and just how exciting and also fraught with risk this revolution is. And I don't think there's any other way to put it. This feels like it's going to be on par with or more transformative to social, political, and economic life than even the Industrial Revolution was. So there's a lot to discuss in terms of technology, the business opportunities, the risks to people's livelihoods and to society, and the efforts at regulating such a rapidly evolving field. For anyone who is new to the program, Hidden Forces is listener supported. We don't accept advertisers or commercial sponsors. The entire show is funded from top to bottom by listeners like you. If you want access to the second hour of today's conversation with Adam, head over to hiddenforces.io/subscribe and sign up to one of our 3 content tiers. All subscribers gain access to our premium feed, which you can use to listen to the rest of today's conversation on your mobile device using your favorite podcast app, just like you're listening to this episode right now. Adam, stick around. We're going to move the rest of our conversation onto the premium feed. If you want to listen in on the rest of today's conversation, head over to hiddenforces.io/subscribe and join our premium feed. If you want to join in on the conversation and become a member of the Hidden Forces Genius community, you can also do that through our subscriber page. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. You can follow me on Twitter at Kofinas, and you can email me at info@hiddenforces.io. As always, thanks for listening. We'll see you next time.